Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. David Rosenberg of Rosenberg Research spoke with Wealthion and spoke about the U.S. debt spending and the effect on the economy and the housing market. He also played Prime Minister of Canada and explained how he would stimulate the Canadian economy.
And just to clarify something you said about GDP growth and also government spending, you're saying because the government has implemented so many programs and spent so much money, trillions and trillions of dollars with the Inflation Reduction Act and the CHIPS Act and many other programs, it's not real growth. This is just a one-off. And if we get a change in government come November, that could change drastically come 2025.
Well, I'm not going to say it's not real growth because government is part of the economy and government spending is part of GDP. What I am saying is that the impetus to headline GDP growth from government and the antidote that it provided from what the Fed has done was not something I would deem to be permanent. It was temporary. And so a lot of that showed up in last year's growth, which admittedly was unanticipatedly strong. But the main point is that these are, whether it's government, whether it's double-digit growth in credit cards, which that was a little bizarre, but it's over. And the excess savings file. I mean, you don't have the savings rate, the personal savings rate, that decision between how you're going to treat your after-tax dollar of earnings. I mean, the American consumer is now just saving 3 cents of every after-tax dollar they're earning. They're only saving 3 cents. Historically, they saved 8 to 10 cents. So, you know, a lot of that wild behavior, which really was a COVID impact of, YOLO spending. You only live once. YOLO and Main Street is what FOMO is to Wall Street. Revenge spending, anger spending, and a lot of that went into services. That's basically dissipated. So that's the primary reason. Of course, and take a look when people that say, oh, well, interest rates don't matter anymore in the new economy. Sure. Tell that to anybody in the housing industry right now in the United States, or in Canada for that matter. Housing is actually in a fundamental downtrend south of the border. And not home prices, but housing activity that filters into GDP. Auto sales are going nowhere. When you look at the classic credit-sensitive sectors of the economy, interest rates are biting. So that's really the big issue, is that after a year in which the Fed rate hikes were more than offset by a lot of other things that were happening in the economy, which I just mentioned, those other things in the economy, they're done. But as I said before, all the lags from what the Fed has done on interest rates, the reset of the economy fully to this new interest rate regime, that is yet to take place. And that's what I think the macro bulls are missing in this picture.
Yeah, you brought up an interesting point about the housing market, both in the U.S. and also Canada. I actually spoke to somebody recently who is involved in residential construction within the Greater Toronto area, and his revenues are down 25% year over year. And he's what I would call a medium-sized builder. But and I'm sure you also saw the lumber prices. They're down, I believe, 30% in the last 3 months. So all of these things are starting to percolate through the system.
Right. And as you would expect, and it's even more remarkable in the Canadian context when you consider what immigration has done to demographics. But the Bank of Canada, I mean, I always like to say that, Jay Powell always compared himself to Paul Volcker throughout that entire tightening cycle. And if you remember correctly, Paul Volcker is renowned for being the ultimate inflation dragon slayer, but he did that by creating the conditions for back-to-back recessions in the early 1980s. And I always said that Tiff Macklem resembled John Crow back in the late 1980s, early 1990s. And remember that housing is the most interest-sensitive sector of the economy, the most credit-sensitive. And I get this question all the time as to whether, the bank is starting to cut interest rates. Well, that's going to reignite the housing market, to which I say, no. Because it's not just the cost of credit that matters for housing, it's the availability of credit. And now as you're seeing the loan losses and the provisioning pile up on the Canadian banks, they're pulling in their horns. And that means they're tightening credit standards. And you can see that in the data because you look at mortgage growth in Canada, which historically is usually running like, near double digits because we're so housing centric in this country. But mortgage growth and household credit growth in general is running now basically flat to negative, adjusted for inflation. Like you're seeing actual contraction in Canada in credit volume. So it's the availability of credit that matters as well. And the Bank Canada staffers just put out a report showing that there's still a lot of mortgage borrowers who have yet to totally refinance into this much higher interest rate environment that we had in our hands a year ago, 2 years ago, 3 years ago, 5 years ago. So there's going to be a lot more pain. And what that means is that people are going to be compelled to either downsize or sell their property. So we're going to have, and you're seeing it already in the data, you're seeing it in the new listings data in Canada that you're seeing, and this is something that's brand spanking new just in the past few months, is new listings relative to sales have really picked up quite a bit. That is going to put downward pressure on home prices. And at the same time, it's going to lead to, because of that, more supply coming on the market, which of course is going to put a cap on what residential real estate can really provide for the Canadian economy over the course, at least over the next year.
And David, if you were Prime Minister tomorrow, what would be the first three things you would do to stimulate the economy and make it stronger again?
I mean, believe it or not, Canada at the federal level has a lot more latitude to do things to stimulate than the U.S. does. I mean, the U.S. Look, America is the reserve currency, but their debt ratio is so far above ours. I think it's almost triple, and our deficit to GDP ratio is pretty low, especially on the G7 ladder. But I wouldn't do it through spending. That's for sure. We have too much big government in this country to begin with. And that's one of the things that concerns me, is that over this past decade, the corporate share, the business share. Now, look, I am an unabashed capitalist. I believe in the free enterprise system, and so I think that there's always a problem when the business sector share of GDP is going down and the government share of GDP is going up. That's why productivity is a big problem in this country. We have to rely on immigration to boost growth because we can't do it through productivity, because we have a government that doesn't try to promote capital formation. You do that by cutting taxes. So you do it by cutting top marginal rates. You can do it through depreciation allowances. I think that finally in Canada, we have to cobble together with the provinces to reduce interprovincial barriers to trade. But I think that, what you want to do is, and look, we have massive direct investment outflows out of the country. And you see this, by the way, go interview Canadian hockey teams. They can't attract, there's a reason. I mean, the Oilers came close. However, you speak to Canadian hockey teams, they can't compete with American hockey teams because the tax regime in this country is crazy. So that's the first thing I would do, is I would do fundamental tax reform that would reduce the tax burden. And I would prevent the deficit from spiraling by cutting spending, not the growth, cutting spending outright. It's incredible that all the spending that was supposed to be temporary coming out of COVID has managed to stay on the books. I think the spending level is like 30% higher than what the government was predicting it was going to be, even when COVID was hitting. It was supposed to be temporary, but you see, in the government sector, no spending is ever temporary. Now, this wasn't the case in the 90s under a different liberal regime, but let's face it, Jean Chrétien and Paul Martin were fiscal conservatives in the Labour Party, and that's what we have to get back to. So I would say classic reduction of the government share of the economy, let the business sector flourish and allow their share of the economy to grow, and broad-based top marginal tax rate reductions. That's exactly what I would do on day one.
Portfolio manager and chief strategist at Simplify, Michael Green, joined Anthony Scaramucci on Speak Up and talked about the economy from the perspective of the top 10%. He also touched on the debt crisis and also gave some investment advice.
So, the interesting thing about the deficit is unfortunately, there's really two separate sources to it. One is one that Pete Peterson has been warning us about for a very long time, which is the growth of entitlements. We're now here with the retirement of the baby boomers. and that's accelerating. That's creating the non-discretionary expenses, things like Medicare and Social Security, to begin to rise significantly against the collections. There's not really much we can actually do about that other than tell people they're going to have to deal with less, right? We could lower cost of living allowances. We could restrict availability or push retirement ages later, similar to things we did in 1986. But candidly, we dithered and we didn't do that. And now it's probably too late to address many of those. The second source of the deficit is actually a very interesting one, right? It is simply a function of the increase in interest rates. So the actual interest payments on the national debt have now begun to exceed defense spending. They will soon surpass almost all other types of expenses. And we obviously can't change that by not paying those. But it is really a choice that we've made around this idea of we're going to fight inflation through raising interest rates. Now, we'll talk about this later. I think that's a terrible policy. I understand why they think it's working, but the challenge is that when you use, the easiest way to think about what you're doing with the interest rate is it's almost like imagine a scale, right? Or a seesaw. We're trying to move the fulcrum. We're moving something that affects everyone, when what we're really trying to do is address some targeted issues. And as a result, it's furthering this bifurcation in the economy.
So I want to step back before we get into your investment strategy, which I think is so important for our viewers and listeners. I just want you to talk a little bit about the economy, if you don't mind. Your view of the economy right now, maybe sprinkling a little bit of deficit worry or not worry. I know you've presented before, Ted, before. Tell us what you think.
Well, this is an interesting situation. It ties in with, we were talking before a little bit about the political polarization. I would suggest that there's a similar polarization that's now emerged within the US economy, where if you happen to have cash, if you happen to have assets, you're doing extraordinarily well. And so anyone kind of in the 10th percentile and above is really experiencing a fantastic environment. Those who are below that and are not benefiting from those underlying dynamics are starting to feel more and more stress. The cost of living, the inflation impacts them significantly more because they have a lower capability to save. So more of their dollars get spent. They pay more of the penalty associated with the inflation increase or the price level increase that we've seen. They also don't benefit from the much higher interest rates that have dramatically increased the cash that's available to those who had been saving in a low interest rate environment, right? So by saving, I simply mean typically just getting older, right? So we've actually created a condition under which it's not just kind of the 10th percentile, but it is really this split of, do you have assets? Have you saved for retirement? And suddenly you're receiving an unexpected windfall from a dramatic increase in interest rates, even as those who are younger in life, who need the jobs, who need to borrow in order to obtain the capital goods that they'd like to have, things like houses, things like cars, et cetera, are really suffering in this environment. And so I think it contributes to the political polarization where nobody really has a shared common experience anymore, right? It's really bad if you're, below the 75th percentile and you are, young, and it's very bad if you are, an older person who hasn't accumulated assets, because you're watching your accumulated reserves and things like Social Security cover less and less of your underlying bills.
Give our investors some ideas about your investment discipline, the way you think about investing, and maybe some actionable things that they can do. And again, you don't have to be specific in terms of a stock, but I'm talking more about way of thinking.
Well, I think that there's a couple of things. Today we actually had data that came out that showed on the conference board expectations that consumers expect the stock market to continue to soar, even as they expect the economy to continue to weaken, right? Business performance to continue to deteriorate. This is not dissimilar to, the general perspective that people seem to have at this point, that the stock market has largely divorced itself from the reality of the economy that they're experiencing. The irony, of course, is very much like the late 1990s period. We're seeing an extraordinary bifurcation, there's that word again, between the haves and the have-nots in the stock market. There are a very few number of mega cap companies that are rising rapidly. This has pulled cap-weighted indices higher, even as metrics like the Russell 2000 equal-weighted or the S&P 500 equal-weighted have languished, right, with relative underperformance. In the case of the Russell, small companies are actually down on a year-to-date basis, with the S&P up, give or take 15%. The Russell 2000 equal weight is down about 6%. So we've got this bifurcation occurring across all across sizes and company attributes as well. Anyone who walks down the main street of their local town will see symptoms of this in the lack of occupancy in retail establishments. I was just in Manhattan. It's astonishing to see vacant storefronts on Fifth Avenue at the time when the stock market is at all-time highs. It feels completely insane, but it is very much something that we're experiencing. Walgreens just announced today that they're closing 2,200 stores, right? And then we turn around and we look at things like same-store sales, and we say, oh, those are going up, right? Things must be fantastic. Well, you reduce the denominator, it gets a lot easier, right? So when you think about all of these things in terms of how to influence your behavior, the most important thing is, in my opinion, always to stop and say, can I get what I need at the lowest possible risk? Right. And I would encourage a lot of people to look at the pool of opportunities that are out there today. And off of the asset base that we have, many investors are remarkably well served with simply buying high quality corporate debt or by buying bonds. And the key question there is this one of inflation, right? That's what we just don't know. And so that's creating uncertainty. It's leading to people engaged in all sorts of synthetic creation of fixed income instruments. And let me just explain what that means. I'm sure many of your listeners have been exposed to things like call overwriting strategies, right? These would be funds that engage in owning the underlying and then selling a call option against it, right? Many of your listeners have probably recently been exposed to things called buffer funds, right? A buffer fund is simply I buy a zero coupon bill, effectively, right? A discounted bill with a 1 year to maturity. And then I use so if I spend $1 on that, or I spend $100 notional, right? So if I buy a face value bond that is discounted by the current 5%, I'm going to pay 95 cents on the dollar for that. I then take that remaining 5 cents and I buy a call spread, right? So I'm effectively giving up the return on my bond so that I can gain the potential for a slightly higher return if the stock market were to go up. All of these are super interesting types of strategies, but at the end of the day, what you need to recognize is you're giving up that 5%, right? And so that's one of the key questions that I challenge people. I do this with institutional investors on a very regular basis. Are you actually getting your needs met by that 5%? And if so, why are you taking significant additional risk?
That's smart.
Right?
Concern about over-leveraged banks was a topic covered by Jonathan Welllum of Rocklink. He talked about the impact that will have on personal and commercial loans. He also touched on the unsustainability of the U.S. debt and how much longer it can continue.
So I'm curious about the comments you made about the Canadian banks and why you have such a low weighting in them. And I guess you're really concerned about the leverage that they currently have. And I want to dive deeper into that. And when you look at the Canadian banks, it's a huge range in terms of performance this year. Royal Bank is up 5% on the year, but TD Bank is down, I believe, 12 to 15% on the year. But maybe you can give us some more detail on why you're so concerned and what's happening within their loan portfolios. And do you see the risk coming from the residential side or commercial or both?
Yeah, I think it both. And it's interesting to see the divergence, no question. Royal Bank has been much more disciplined, and they didn't, back about a year ago, 2 years ago, I guess, we started looking at the average amortization period of mortgages, and it started to really start stretching out. And I'm sure, talked to people who have talked about this already. And so what the banks were doing is basically negotiating with clients and allowing them to extend the amortization period in order to deal with the increasing interest rates. And we look at that and we go, that's not a good thing. When you've got, 18, 20% of the mortgage is amortizing at 35 years now, that's more renting than it is ownership. And so you start to get a little worried about that. So from our perspective, given the housing bubble, or certainly very high prices of housing, and then the fact that we've had so many people topping up and buying homes at high valuations and at low interest rates, and then you've got this revaluation of interest rates, that makes the personal or the retail side of the business very vulnerable. And we think that, again, even if it doesn't blow up, and I'm not, we're not looking at this as Armageddon. I mean, Armageddon could hit, at any time for a whole bunch of other reasons, but it's just going to be more and more loan losses and write downs, and there's not going to be, the growth is going to be really hard to come by. And so there's going to be under pressure. And when you're leveraged, 12 to 1, that just puts pressure on the commercial side. Also, we talked to, we have a commercial, we rent here in Burlington. We talked to a number of the large real estate agents in this area. And boy, it is abysmal when it comes to top tier office space. You're running around here in Burlington, all through the area. Like a lot of these buildings are like half full. People are working from home. The larger companies have, changed work patterns for their employees, and there's a lot of stress. So the industrial is pretty solid. Tier 2 office is so, but there's just pockets where there's problems, and the banks are they're making it very difficult for renegotiations. They're walking from mortgages. I was just talking to a real estate agent a couple of days ago, and she says it's amazing. People will line up a mortgage with the bank, and the next thing you know, before they even close, they'll back out. They're really watching their loan book very carefully. So that's good in one sense. I mean, banks are trying to protect themselves, but I think in terms of looking for asset appreciation and growth, we just look at it as dead money. It's just going to be very difficult. Now, that's a general statement. We've seen that there are differences. Royal Bank did not get into the extending and larger amortization periods as much as Bank of Montreal, and I think CIBC, TD did a little bit more of that. So the banks have a little bit different allocations there. The other thing is that TD, of course, got caught in the money laundering situation in the United States, which is probably what's taken them down a little bit more. And that's so you always got something that can. An exogenous sort of factor that can hit one bank over another one. But I think just overall, retail situation is just going to be under pressure, and then the commercial doesn't help it at all. And so that softness, I think, will makes them unattractive at best. In fact, in Canada, some of the best performing up until the fact that up until they announced the Canadian Western Bank purchase. I mean, National Bank was doing very well and continues to plod along. And it's interesting because they're sort of more of a basic fee-based kind of business. They're not involved in a lot of the heavy, extensive lending and international operations like the other banks. So I'm not saying they're going to blow up. I'm just looking at them as leveraged. As you know, whenever you're leveraged a lot, and if things don't work out well, mortgages certainly are underwater. It's a lot more Canadians underwater. Housing prices have easily dropped 20%. All around the area where I am, and I'm looking at people who bought 2-3 years ago are down in some cases 25% from the peak if they bought right at the wrong time. That's going to have to run through the system. And part of it also, James, is looking at 15 years of almost negative in 0 to negative interest rates, and we're going to pay up for that. And so we just don't want to be in businesses that could be more vulnerable to that payment problem. Going back to more of an equilibrium in the marketplace.
Yeah, I had a conversation with somebody recently who's investing in numerous condos in downtown Toronto, and I think she said she has a portfolio of 6 condos, and she's losing money on 6 of them because her rent is $3,000 a month, but her expenses are over $4,000 a month. Mm-hmm. And then of course there's the big reset associated with the valuation of the condo, right? So maybe it was worth $1 million 3 years ago, and now it's down to $750,000. So that's another big problem that's coming. And as you know, there's dozens and dozens of condos being built in downtown Toronto or in the greater Toronto area. And that's going to be another major issue in 2 or 3 years from now when people take over these condos, right? When they first bought them, they were worth $1 million, let's just say, and now they're going to be worth $750,000. So they're taking a big hit.
Well, and in many of these cities, they're not governed well. So the cities aren't governed well. Who wants to live downtown? I mean, there's a big shift going on, and so that's another factor, that the safety and the cleanliness, and do you want to be living in these downtown facilities? So if you just start to move that market just a certain percentage out, it really moves the value of these properties in a significant way. And so, we're again, those are all the reasons why we're just looking at it and saying, you know what, it's easier to go somewhere else. You can spend hours and hours and days and running all your spreadsheets and Excel spreadsheets and so forth. And I'm not sure it really gets to you. It adds a lot more value. And so we just say, hey, let's go somewhere else. I mean, it's like Warren Buffett, I think, and Charlie Munger used to say, they have that pile, that inbox on their desk, too hard. And so we look at some of these banks and we go, are they really going to make much money in the next few years? Are they going to go sideways at best, or maybe have some challenges? Let's go somewhere else where we don't have to think about it. And we're quite happy to do that in terms of where we're investing anyway. That's the benefit of being way off the index and just looking for a handful of companies that you like. We don't have to be in one sector. We can just stay clear of it if we want.
So let's talk about the U.S. economy now, because really one of the only things that's really saving the Canadian economy is still the strength of the U.S. economy. But it appears to be slowing also. Q1 GDP was recently revised to 1.3%, down from 1.6%. And then there's a number of companies that are coming out and saying the consumer isn't spending money like they used to. Starbucks, for example, came out with quarterly numbers saying the consumer in both the US and China were spending a lot less. They're not getting as much traffic into their stores. McDonald's also came out with and said the same thing. And I'm sure you heard about McDonald's implementing the new $5 a meal program. They're trying to get people back into their stores. And then when you look at the price of oil, in spite of what's happening in the Middle East, it's hanging in between $70 to $80 a barrel. Maybe that's a reflection of a weakening economy. I read recently about lumber being down 30% in the last 3 months. What's your sense of the U.S. economy here? Do you think there's reason for concern?
Yeah, I mean, it's under a lot of pressure. I mean, I think that when we look at the U.S. economy, we're looking at the businesses and how they're reporting. And as you've pointed out, you've given us a number of companies, and we've seen the same thing, where it's discretionary spending. It is down. It's under a lot of pressure. And in certain states, it's even worse. So if you actually look at the states that are, higher taxation levels, higher regulations, so those areas are even doing worse. And so, no, I think the U.S. is definitely slowing, and that would be expected. You've gone from almost zero interest rates up to 5%, and so that's being priced in. The thing that's really helped the U.S. is just these massive, deficits, and they're spending a lot of money, a lot of stimulation. Immigrants, these people flooding across the borders, money being spent at the municipal level, state level to support those initiatives and so forth. And then you've got a couple of wars, which obviously stimulate, more deficit spending. If it wasn't for that, I think the U.S. would be much worse off, and the numbers would be worse, and it'd be in a recession. And also, I think from our perspective, we look to individuals like we have a lot of respect for David Rosenberg, who looks under the hood on these things, and you start looking at the employment numbers, and you realize they're not really as healthy as they're saying, and even the CPI numbers, we don't really take those as the ultimate judge of inflation. Inflation is definitely running higher than that, and so forth. So we put all of that together, and we go, it's tougher. The companies are having a tougher time growing their earnings, unless you're in certain areas that are favored. The stock market is being driven by fewer and fewer companies. Small cap companies have not done well this year. They're under a lot of pressure, and so it's a very split market. And I think that that's the Fed is seeing some of that, and that will give them some incentives to see if they can't sort of knock rates down a little bit. In the debt, again, we talked about this, other people talk about it. It's just not sustainable, and what's not sustainable will not be sustained. The fact that they've continued to be able to pull this forward and get away with this does not mean that they can continue to get away with it in the future. And so with a 35, almost going to $36 trillion deficit, at 3-4%, that's over $1 trillion a year in interest now. And so these things are just really putting a lot of pressure on the U.S. economy also. And I think a lot will depend on the election also in the fall. I mean, clearly you've got quite the different worldview going on between Biden and Trump. And Trump clearly is much more growth oriented, cutting regulations, cutting taxation. But if God forbid the Democrats were elected again in that country, I mean, they've got taxation going up automatically. The Trump cuts from previously, they all of a sudden will kick in, and Biden seems convinced that taxation should go up, and that would be, I think, devastating to the growth prospects of the U.S. So we're just watching that, and that's why we're being very careful. That's why we're in companies that we think can weather, more pressure and very poor decision making on the part of the politicians, and also have global franchises so they can make money in not just one country or two countries, but make money around the world, and are sort of perched on long-term trends. So I think the U.S. is going to be increasing under more and more pressure economically, and we've seen that already.
Ben Laidler from eToro is preparing us for a market shakeup, although he is bullish through the end of the year. Like Jonathan Welllum, he is concerned about the future bond auctions and the size of the debt. He also thinks cryptocurrency is here to stay and could become more mainstream in time. I want to touch on energy for a minute because we do need energy to power AI. And we saw the same thing, and there's been a lot of talk about it. Look, we need data centers. We need power to power this. They're talking about uranium and all this stuff to power the AI that we're all going to use. The question becomes, we saw the same thing in the dot-com bubble. Oh, everybody's going to need a computer. Everybody's going to be on the internet. We need the power. But then that sort of, there was that peak and then it kind of dropped off a cliff. Are we looking at the same thing here as far as power goes for AI?
So we're certainly having an explosion of data center activity. It's helped make utilities, surprisingly, one of the best sector performers, so far this year, despite being perceived as defensive, despite as being sort of rate sensitive, it's done very well. The International Energy Agency is out there saying that data center demand is going to go from 2 to 3% of total electricity demand to sort of double that over the next 2-3 years, which is basically a new Japan. That ChatGPT uses 10 times as much power for a search as Google does. So there's all these sort of supportive stats out there. So I think, that demand is coming. I think what we miss is a couple of things. So one, there will be efficiencies, along the way. There will be new ways of doing things along the way. I'm not sure we can just extrapolate things forward, A. And B, in terms of the market impact, I think, just going back to your dot-com sort of analogy, where we got it wrong in the dot-com was on the valuations, not on the fundamentals. Basically, everything we said on the fundamentals of the internet becoming a thing and taking over the world and driving revenues and everything else all happened. We were just grotesquely overpaying for it. Cisco 110 times, if that's your NVIDIA comparison back then, Cisco peaked at 110 times price earnings ratio, and it's never recovered, even though revenues are up 7 or 8 times. So the revenues delivered, but the valuation was wrong. And that's what's different sort of this time round. I think AI has moved from hype to reality. You're seeing that in the numbers. And we're certainly not overpaying for it yet. I mean, NVIDIA, which is the sort of poster child, is 45 times PE? Absolutely not cheap, but neither is it on those, stratospheric valuations we saw back in the dot-com boom and bust.
Ben, what about the deficit? I mean, we're looking at over $35 trillion. I think within the next few days, there's another bond auction. The 2-year, the 10-year, I believe, maybe even a 5-year in there. And the prices are in the upper 4s at this point. So if you're on fixed income and you have money put away, you say, okay, maybe this isn't so bad. I know what I'm getting. But there's going to come a point where these bond auctions are going to fail because they need to raise so much money. And this is going to be a huge problem for us.
So it's a problem. I don't think it becomes a market problem until it does. And that sounds flippant, but, the absolute numbers are not too terrifying. US debt to GDP, 120%. There are plenty of places in the world, most of Europe, certainly Japan, that have much higher numbers than that. But your point, I think it's the direction of travel that we're running, that sort of deficit, 6% of GDP when the economy is frankly booming. And you don't normally see these deficits outside of, recession. So that's a concern. And B, we're about to go into an election. Neither candidate is addressing this. Or neither party, neither Congress is addressing this. And what this means is that ultimately the market will address it. And the bond vigilantes will see a comeback and they will address it. The struggle is, is that tomorrow or is that in 10 years' time? I can't answer that, but I definitely think it's one of these sort of tail risks you need to be thinking about, and it's absolutely a government problem. I mean, we've basically seen corporates and consumers, deleverage over the last sort of 5 to 10 years. It's government is the one that's still there with its checkbook open, and again, if they're not going to close it, the market ultimately will close it for them.
So I want to ask you about cryptocurrency before I leave you. I know you guys are into cryptocurrency. We saw it, look, earlier in the year, it was probably around 26,000, around that number. It jumped over 70,000. Now it's right around 60. It's the volatility that you're talking about, but that's the nature of cryptocurrency. Where do you see this going? And, it's not going anywhere, but at this point, I guess it trades like an equity. And, there is possibility of cryptocurrency becoming more mainstream?
I think that's the long-term story, and I think if you're bullish, that's why you're bullish. This is, the youngest, smallest, and most retail-owned of all the asset classes. And if you believe, as I do, that we're at the early stage of this sort of gradual adoption cycle, that should drive value over time. We've seen the Bitcoin ETFs this year. We have the Ethereum ETFs coming. We've had the Bitcoin halving. We have a number of sort of institutionalization sort of landmarks coming. We have regulations coming at the end of the year, which are going to make it easier for US companies to own crypto, and basically none of them do today. We have global regulations coming, making it easier for banks to own crypto on the 1st of January next year. So I think all this is just part of this gradual institutionalization. So I have absolutely no idea where crypto is going to be over the next, days, weeks, months. But I think that long-term story remains very positive. And despite all this volatility, it's the best performing asset class last year. It's the best performing asset class this year. You need to manage that volatility. Diversification is the only sort of free lunch in finance, and that applies in spades to crypto. But I think the long-term outlook remains pretty positive.
Obviously, all these things you mentioned are vehicles and avenues for crypto to be adopted as a currency, if you will. Is you see it getting there? Obviously, you're bullish on crypto and you think it's going to get there, but it's going to be a few years, if not longer, down the road.
I think this is always 2 steps forward, sort of 1 step back. But I do think you've had a big step forward this year. I mean, the Bitcoin ETFs, which make it easier for people to own crypto in the world's biggest capital market, as we just sort of talked about. You've seen 15 billion of inflows into Bitcoin so far this year. That's going to come for Ethereum. You've had sort of orange lights given by the SEC, so I think that's fully coming. And as I say, I think you have a lot more of these catalysts still to come. Companies basically don't use crypto today. The regulations will make that easier. Banks have been very nervous. I think that will change. Ultimately, I think you'll see a central bank confessing to owning sort of Bitcoin as part of its sort of currency reserves. I think gold is 15% of global currency reserves, right now. So I guess what I find, again, Bitcoin's been around, or crypto's been around for only 10 years. This is a tiny asset class in global perspective. It's dominated by retail investors today. I just think there's so many different avenues that this could sort of develop over time.
Finally, on Next Week on the Trading Floor, Jon Najarian discussed the NVIDIA stock split and how that worked, and also explained a reverse stock split. He's still bullish on AI despite the recent pullbacks. Jon, let's start here with NVIDIA. It's now 2 weeks since the stock split. It went on a roll, going up about 17% since the split, but is now coming back to earth.
Yeah, well, Andrew, NVIDIA, it's all about AI. I mean, this stock rocked to the upside after that 10-for-1 stock split. Now, was that the primary driver? It did make the stock accessible to a lot more investors. We all know that when you do a 1-for-10 stock split, you're going to have 10 times as many shares at 1/10 the price. So basically, nothing changed. It's the same thing, by the way, when you do a reverse stock split. And people are doing that. I'll touch on it in a sec. But when you're doing a stock split, a traditional stock split, it's because your share price has run to a point where it is unattainable for some people to be able to trade it, invest in it, and so forth. Classic example, Warren Buffett's Berkshire Hathaway. It's in the hundreds of thousands of dollars. That's per share, folks. One share, a single share, will set you back more than the most expensive home in 90% of America. That's the way that stock operates. And Warren Buffett has no intention of cutting that one. So they have a baby Berkshire that trades at a fraction of that. And even that is pretty expensive. But these days, with these trillion-dollar monsters like NVIDIA and, for instance, an up-and-coming trillion-dollar monster like Broadcom, symbol AVGO, you've got people that are doing these 10-for-1 stock splits because an $800 stock, a $1,300 stock is just too difficult, again, for most people to trade, to invest in, and so forth. And it's not just for the investor class that the board of directors decides to do these stock splits. They do it because of their employees as well, because as you might imagine, some of these employees can become crazy rich through their stock ownership plans. Good for them. But the access for them trading out of these shares, hedging these shares, all that sort of stuff is just as difficult as it is for Joe and Jane, who have never worked for Broadcom, never worked for NVIDIA. So they do these stock splits to make the stocks more attainable, more easily hedgeable, and so forth. Now, reverse stock splits are pretty much the opposite. We've seen that with the likes of, Virgin Galactic, for instance. Now, this was a stock that people were big believers in, even though it just took people to the just under outer space, if you will. Blue Origin, Jeff Bezos's other company, along with Elon Musk's SpaceX, can both take you out into space. But Virgin Galactic doesn't have the ability to even take you out into space. And the stock has fallen and fallen and fallen to where it's under $1. Well, it's going to get delisted from the exchanges if it doesn't trade back up over that $5 level. And so what they do is they do a reverse stock split, which is the exact opposite, Andrew, of what NVIDIA is doing. A 1-for-10 stock split means, like I said, 10 times as many shares at 1/10 the price. So if you run that the opposite direction, if you've got a 33-cent stock and you'd like to make it a $3.30 stock, you're doing a 1-for-10 reverse stock split, in which case you're going to get the stock price 10 times higher, but you're going to have a significant different move than NVIDIA with 10 times as many shares. Nope, 1/10 as many shares. So two different ways of looking at stock splits. One, the traditional stock split. The other, a 1-for-10 or even a 1-for-30 to get the stock back up over a minimum listing level are things that people do out of both desperation and the desire to keep that stock listed on the big exchanges rather than going to bulletin boards and so forth. Additionally, there are a lot of firms, hedge funds and endowments and things like that, where they have a mandate to not trade stocks that are under $5 a share. Is that a law? It's not a law, but a lot of people adopt that, and they simply will not trade a stock that isn't at least $5 a share. So several reasons why these reverse stock splits are very popular, and people are out there soliciting from their board of directors an opinion that lets them do a 1-for-10 or a 1-for-30 reverse stock split, which is what Virgin Galactic is going through.
Thank you for watching this week's recap. Don't forget to head over to Wealthion.com for a free, no-obligation portfolio review with one of our registered investment advisors. And please, follow us on social media for the latest news and information to help you invest wisely. If you haven't done so already, please make sure to like and subscribe to our channel, and don't forget to turn on notifications to the channel so that you never miss a video. Thanks for watching. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and looking for more ways to keep and growing your investments, watch this video next.